All right, let's jump straight in. Welcome to The Explainer. Today, we are setting the stage for a massive, deep dive, fundamental breakdown of India's absolute largest airline, InterGlobe Aviation, better known to all of us as IndiGo. We're going to put this aviation giant through a rigorous stress test, digging into their massive scale, uncovering some hidden financial realities, and looking really closely at the turbulent events that have recently rocked their operations. Get ready because we are breaking down the entire investment thesis right now.
Welcome to Stress-Free Investing Analysis. Personal notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
Okay, real quick, here is our roadmap for this explainer. First up, the aviation flywheel. Second, financial health and shenanigans. Third, red flags and governance. Fourth, valuation and future scenarios. And finally, we'll wrap it up with the final verdict.
Part 1. The aviation flywheel. Let's look at the engine of this beast.
64. Just let that number sink in for a second. 64%. That is IndiGo's domestic market share. It's a network density moat that basically gives them absolute, undisputed dominance over the Indian skies. I mean, with over 440 aircraft and 2,200 daily flights, competitors like Air India or Akasa would literally need 5 to 7 years of flawless execution just to catch up to this kind of scale.
But here's where we hit the ultimate paradox. On one hand, they have this world-class cost discipline. Their cost per available seat kilometer, excluding fuel, is just 2.9 rupees. That is the lowest among the top 10 global low-cost carriers. It's incredible. But on the flip side, those razor-thin margins mean that any spike in Brent crude oil above $90 a barrel, or honestly any sharp drop in the rupee, is just an immediate, massive threat to their bottom line.
So how does that translate to the balance sheet? Let's get into Part 2, Financial Health and Shenanigans.
Okay, so the top-line growth is just mind-blowing. They crossed the $10 billion mark, hitting over 80,800 crores in revenue for FY25. Plus, they're showing a massive free cash flow of over 21,700 crores. Sounds perfect, right? Well, look at the interest coverage ratio. It dropped to 2.2x. That sub-3x coverage shows you exactly how tight the financial rope is that they're walking. Because they have such a lease-heavy balance sheet, it really drags that interest coverage down.
And speaking of that cash flow, we need to talk about financial shenanigans. You know that massive free cash flow number we just hyped up? Actually, nearly 14,910 crores of their FY25 income came directly from sale and leaseback gains. Now, don't get me wrong, this is completely legal and totally standard in the aviation industry, but it masks the true quality of their actual operating income. If you strip out those leaseback gains, their operational profitability looks entirely different.
Which brings us to the turbulent stuff. Part 3. Red flags and governance.
This timeline perfectly maps out a severe loss of operational invincibility. It all started back in December 2025 with major compliance failures around flight duty time limitations. That caused massive cancellations affecting over 900,000 passengers. Just a total nightmare. And that directly led to a massive governance gap when CEO Peter Elbers abruptly resigned in March 2026. Then came the regulatory stress with a record 22.2 crore DGCF fine. Now, while everyone is basically holding their breath for legendary aviation executive Willie Walsh to take the helm in August 2026.
And while all this is happening, the ownership shift is absolutely fascinating. Take a look at the Gangwal Trust. Co-founder Rakesh Gangwal, literally the architect of IndiGo's operational philosophy, is aggressively exiting. He's sold off a huge chunk of his stake. But then, on the flip side, domestic institutions and mutual funds are heavily buying into the repair story. They now hold over 31% of the company.
So what does all this mean for the stock price? Let's dive into Part 4, Valuation and Future Scenarios.
The Peter Trotsky F-score is sitting at a 6 out of 9. So what does that actually mean for you? Well, it tells us we're looking at moderate, improving financial quality post-COVID. It's a solid score. It proves they've repaired their business. But because of that rising leverage we talked about earlier, it keeps them from being a top-tier, bulletproof 8 or 9 franchise right now.
When we map it all out, our probability-weighted base target sits at 4,825 rupees. We give that base scenario about a 55% probability, suggesting a pretty modest 13% upside from the current market price of around 4,265. And honestly, the downside risk in the bear case is pretty steep, dropping to 2,800 if those operational issues persist and fuel costs spike.
The million-dollar, or rather the billion-dollar question is this. Can Willie Walsh successfully execute their really ambitious wide-body long-haul pivot? The entire bull case, the one that gets us to that 6,500 rupee target, hinges on this single question. Turning a strictly domestic, low-cost carrier into an international powerhouse with a brand-new fleet of A350s is an incredibly high-stakes maneuver. Sure, Willie Walsh has the pedigree. He turned around British Airways, but he is inheriting an airline under serious operational stress.
All right, bringing it all together. Part 5, the final verdict.
Our official stress-free score lands squarely at a 51 out of 100. It's right down the middle, and it's a direct reflection of this massive, undeniably powerful economic moat that is unfortunately being dragged down heavily by acute governance issues, regulatory fines, and management red flags.
So here is your clear action plan. We are placing IndiGo on a strict hold and watch. If you're an existing investor, just hold. The brand's moat is intact and it will likely recover. But for new buyers, wait. The execution risk is way too high right now. You should demand a wider margin of safety, ideally looking for an entry between 3,800 and 4,000 rupees. Your main catalyst to watch? Keep a very close eye on the May 27th results, and definitely tune in to Willie Walsh's first earnings call in August to see if this turnaround is actually taking flight.
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.